afternoon and happy Friday, everyone. I'm Dave Weisberger, the CEO of CoinRoutes. It's time for This Week in Crypto for Friday, June 30th, 2023. And even though it's before a holiday week when I wasn't thinking that we would do a weekly recap, there is so much news that needs to be talked about that here we go. We'll start with the markets. The markets, when you look at Bitcoin and Ethereum, if you only look at the headline number, you would say nothing has happened. It's more or less where it was last week, within 1% or 2% of both. But there's obviously been a fair amount of volatility. But the market feature this week that's most interesting is the incredible move, 70% up in Bitcoin Cash and a 30% up move in Litecoin, seemingly driven by the fact that they will be listed along with Bitcoin and Ethereum on a new exchange called EDX that is slated for full operations in the fall. And it's one that CoinRoutes will connect to for our clients when it becomes fully cleared solution, because that way it becomes very usable. Now, other than that, there's not a whole lot to say about the market action this week because it's really being driven by the news flow. Now, I'm going to break the news flow into two pieces. The first, we're going to talk about the entire saga of SEC regulation and all the news story that's come out around that. And then we're going to conclude with a look at FTX and the rumors that they're trying to restart. So let's dive right into the news stories. The first one, which came out right at the end of last week that I think is interesting, is the IMF telling us that they don't believe it makes sense to ban crypto, but really just to regulate it. Now, that kind of feeds into the conspiracy theories that walk through with BlackRock and other people worrying that BlackRock and Fidelity are going to take over the crypto movement from the people, the cypherpunks and the freedom advocates that it started with. I don't know if I believe any of that, but it is interesting. The second interesting tidbit before we get into the meaty stories were Maxine Waters specifically formally requesting information from both Gary Gensler at the SEC and Janet Yellen on the Treasury to talk about the McHenry bill, which we talked about the last couple of weeks, trying to understand, do we really need crypto regulation or not? Now, this is a stark departure from reading pure talking points at hearings, and it indicates that there's political pressure being put on her and other members to really dig in and understand what's true. For those of you that watched my video from 2 days ago on the Prometheum saga, I went into depth why that was a complete nonsensical approach to try to say that regulation is good enough for regulating crypto. That's clearly not true. But it's funny when you see Maxine Waters asking for this information, she's essentially kind of saying, yeah, I kind of get the fact that she's getting pressure. So that matters. The next story that's interesting that I don't want to spend a lot of time on is Prime Trust falling into receivership. Now, why I mention Prime Trust at this point, even though it's a shell of what it used to be, it doesn't have that many assets. And yes, it is a black mark on crypto, is that it was a regulated institution that still managed to lose keys, and the humans involved committed what seems to be fraudulent activities to cover up those loss of keys. Now, I mention this because anyone who thinks that regulation is a panacea hasn't been paying attention to the billions of dollars in fines that regulated institutions have to pay. But it is still a black mark in crypto, and it means it puts a premium on really good actors in the space. Next piece of news, Fidelity finally formally applies for their spot ETF, and it looks a lot like, interestingly, the BlackRock one, except for their partnership agreement is with CBOE as well as with Coinbase seemingly as well. So for now, we have two of the four biggest asset managers in the world applying for a Bitcoin ETF. Two of the four largest asset managers in the world with all of their clients and the multiple trillions of dollars they manage on the other side of what has been an interesting SEC denial process. So, what's the news out of the SEC? Because here's where the story really gets interesting. Well, the first thing that happened since we last talked is they approved a Bitcoin leveraged ETF based on futures. Now, anyone who's watched regularly knows that I am a big believer that the average trader and investor should not use leverage. That Bitcoin is already trading like an option on its own adoption, has a volatility, i.e. a movement, that is dramatically higher than the average asset. And as a result, but using leverage to buy or sell Bitcoin is something that is extremely dangerous. Yet the SEC approved that. So obviously their reasoning is nothing to do with protecting investors from Bitcoin and the ability to trade or invest in it. Their reasoning is on more technical matters. And that's where the next news story becomes really interesting. So this morning, something basically unprecedented happened. The Wall Street Journal published something, which was obviously leaked from the SEC, saying that the recent ETF approvals need to enhance or clarify the surveillance agreement. Now, what's interesting is opponents of Bitcoin, like John Reed Stark, who basically believes that we should still be using paper confirms and paper disclosures, he said, well, that shows you they're still going to deny it. And maybe they will if they're dumb. But what it really shows to me is this is a watershed moment. The fact is, we always say, first they laugh at you, then they ignore you, then they fight you, and then you win. But there's a step in the middle of that. After they fight you, but before you win, they negotiate with you and try to get as good a policy as they can before the inevitable victory. And I think that's where we are now. So let's talk about, what do I mean by that? What could they be asking for? Well, what I think they should be asking for is the same thing that exists in the equity markets. Now, people watching this may not know, but every broker that has a retail account has to do something called a SARS, a suspicious activity reporting. And when they do a SAR, whenever they see something they think might be manipulative, and it is their duty to the regulators to produce those, and it is also their duty to comply when the regulator says this was reported, to actually say who was the person doing it on the other side, or at least investigate who the actual person was. So what I think the SEC is likely to ask for is basically this, that if they detect, or if an exchange, in this particular case, Coinbase, which we know is using NASDAQ's smart system, if that flags activity as suspicious, report it to the SEC as part of the information sharing agreement. And if the SEC thinks it's important enough, report who the person is on the other side so that they can develop their case. That, which is the same process that we have for equities, I think is what the SEC is asking for. And if they get it, and I can't see why they would say no to this, if they get it, then that gives the SEC the opportunity to do something interesting. It gives them the opportunity to approve the Bitcoin spot ETFs and do so claiming victory, claiming that they protected investors, because after all, their 5 years of intransigence on the subject, forcing investors into dramatically inferior products, was good. Because now, with this superior product, there will be information sharing, there will be the ability to spot and surveil against malfeasance. Now, do I agree with that? I don't know. I mean, I think it's not a horrible outcome, but I definitely see the rhetorical value to the SEC to take a win and to take an issue away from the opponents. Let's face it, there are lots of people out there who believe that a Bitcoin ETF is popular. We've seen opinion polls saying Bitcoin ETFs are popular, and as a result, the SEC really can't afford to be turning more and more of the electorate against this administration. So the ability to take a win, I think, is a really good deal. At the same time, literally also this week, the day before the SEC leaked this, Coinbase released their defense to the SEC's attack. And what a doozy it was. I have legal friends of mine, lawyer friends of mine, saying it was poetry. I read it and thought it was incredibly well stated. Effectively, what the SEC is doing, according to Coinbase, is exceeding their jurisdiction, and they don't have standing to bring these charges. They're making the argument that they've contradicted themselves, and they pulled up testimony from Gary Gensler in 2021 that would support it. And they're specifically asking the judge to make a ruling on the basis of this. And they're going to use that potentially to go all the way to the Supreme Court, who, if you've been paying attention to West Virginia versus EPA, which invoked the major question doctrine, has held repeatedly that there's been executive overreach. Hell, yesterday, or this morning, I guess, the SEC, the Supreme Court said that ruled against the Biden administration plan on student loan forgiveness, once again citing executive overreach. That seems to be a common theme. So this particular response from Coinbase actually has a path to victory. Now, that path to victory could be years away from now, or it could happen sooner than that. Or the SEC could be cowed into kind of pulling back on a pure jurisdictional basis. We don't know how it's going to play out. What we do know is that there are arguments that are hard for this administration to argue again with this court system that they don't have power and authority. And in this case, the major questions doctrine holds that Congress has clearly signaled its intent to regulate, has clearly said they don't believe there is regulatory authority at the SEC or CFTC to do some of the things that they're doing. And as a result, the SEC should not be able to rule or go after firms like this because it's in violation of congressional intent. That's essentially what's going on here. And we'll see how it all plays out, but it certainly makes it seem more likely than not that Coinbase is going to continue to operate and continue to push on their points. And they're not going to fall over or just do a quick settlement on this unless they're offered some very clear vanilla advice on how they can continue to do their business pretty much in its totality. So it's the last piece of news, which is also interesting, and that is FTX. So evidently, FTX announced this morning that they are planning to restart their international exchange. Now, this is a very fascinating problem because they have one of the worst brands in history in terms of trust, but actually a good brand in terms of technology and what they brought to the table as an exchange. So we'll see whether they reinvigorate the FTX name or change the name or not. I mean, after all, I didn't see anyone trying to bring back Madoff Securities or Enron electricity trading, and for good reason. But when you get beyond the brand, let's ask ourselves, what was FTX? Well, under the covers, certainly nowhere near as profitable as they were claiming because they were juicing it with Alameda returns and other things. They had a platform that was the platform of choice for the institutional trading community. That's just a fact. They offered the most capital efficient platform where you could post Bitcoin as collateral or stablecoins as collateral or Ether as collateral and then trade any instrument. All of that was good. Their liquidation engine, except when they turned it off for Alameda and other friends of theirs, worked really, really well. So what has to happen for FTX to restart? Well, I believe that if and only if they have an audited way of segregating client assets at a custodian that is not named FTX, then and only then will people potentially trust them with their assets. At the same time, they have to open up the transparency on the system itself to make sure that everybody is playing by the same rules, that there's no Alameda-like backdoors for others, that the liquidation engine only operates the same way for everybody in there, that there's no market access deals that were special deals. I think if they do that and they have clarity on the rules, clarity on what's accepted collateral, and that applies to everybody, and the same haircut is given on all collateral. So you can't take some exchange token like FTT as collateral. It has to be Bitcoin and Ether or potentially other coins that they might haircut for liquidity reasons, but not to accept their own exchange tokens and not to accept collateral or extend differential credit to people. I think if they made all of that transparent and auditable with their technology and user interface, they probably could restart and they probably would gain trust, but only if it were surveilled from the outside. Now, would that be good for the market? Of course it would, because what's the other thing they would have to do? All the regulators in every jurisdiction, whether it be Switzerland or Europe or the UK or Dubai or Hong Kong or the smaller regulators like Bermuda or the Bahamas, they are all going to ask much more difficult questions the next time around. And I think that FTX can't afford to restart without effectively working with those regulators to assuage them of the guilt. If they manage to do that, would that be a good thing for the market? Absolutely, because their technology was good and the market does need trusted intermediaries that are doing things in the right way, i.e. protecting customer assets, i.e. having a transparent level playing field, etc. So we'll see what happens, but that would be good if it did go. If they do it any other way, I think it goes down in flames. So with all of that, we have a holiday weekend coming up, or at least a holiday in the United States. So for those of you that are here, have a great 4th of July and stay safe out there.